Welcome to today's event, Best Practice Risk Profiling, Giving Investment Advice that is Suitable with Regard to Risk. This event is brought to you by the AICPA's PFP section, the premier provider of information, resources, advocacy, and guidance for CPAs who specialize in providing estate, tax, retirement, risk management, and investment planning advice to individuals. It's my pleasure to introduce today's presenters. Jeff Davey is co-founder and director of Finametrica. He is the creator of the Finametrica risk profiling system and manages the company's ongoing research activities and relationships with academic and research institutions. Beth Gamble co-founded Pillar Financial Advisors in 1986, where she's been helping wealthy individuals evaluate, coordinate, and implement sophisticated investment, estate, income tax, and charitable giving strategies. For 7 consecutive years, Worth Magazine named Beth as one of the best financial advisors in the country, and she's an active volunteer serving on several committees at the AICPA, the Personal Financial Planning Executive Committee, and 2 terms on the AICPA's National CPA Financial Literacy Commission. And with that, I will hand it over to Jeff to begin today's presentation.
Good morning, everyone. It's a lovely day, or forecast to be a lovely day here in Sydney. It's a little bit after 6 a.m., midwinter day, low 70s, clear skies. Very nice indeed. I should also mention that prior to Finametrica, I had nearly 20 years running a financial planning business. And interestingly, we actually had an accounting arm as part of the financial planning business, and it was in fact the biggest part of our business. And I think that the ideal business model for advice to high net worth individuals, particularly self-employed, but those with substantial investments, is in fact a combination of accounting and financial planning. So I'm very much in line with your thinking, I would imagine, and I do have experience of sitting across a desk from clients. I want to start by just being clear about what we mean by a risk profile, because it's one of those terms that people tend to use fairly loosely, and you get into a conversation and you discover that you're actually talking about 2 different things. So when I use the term risk profile, what I mean is the level of risk that's appropriate having regard to the client's goals, resources, and time horizons, their risk capacity, and their risk tolerance. Goals, resources, and time horizon will actually determine the investment return that's going to be required to meet the goals from the resources that are available. And with that, associated with that investment return, there will be a level of risk. So we can condense the issue down to actually looking at 3 different aspects of risk. Risk, what we call risk required. So it's the risk that's associated with the return that's required to achieve goals from the resources available. And the interesting thing about these 3 is that they're all slightly, they're different. The risk required is how much risk somebody needs to take, and it's a financial construct. It's number crunching. The risk capacity is how much risk somebody can afford to take. And risk tolerance is how much risk somebody would prefer to take. So risk required and risk capacity are financial, risk tolerance is psychological, and part of the challenge of getting a risk profile right is trying to line the psychological element up with the 2 financial elements. Now, people, when working with clients, introduce this concept different ways, but I do think it's very important to be to position the whole exercise with the client so that they understand where you're trying to go with it. I think it's very easy for us to forget how much we actually know about this and how familiar we are with the terms, and every bit of help you can give to your clients to stay on board with you as you go through perhaps some of the complicated exercise is very useful. And Beth, I'd like to just at this stage get your feedback, if I can, on how you introduce this topic to clients.
Sure, Jeff. And I just want to tell the audience is that my firm is a user of Finametrica. We've been using it now for the last 3 years. And we, prior to that, had used a pretty conventional risk questionnaire, which looking back on it now just sort of makes my head want to spin because it was completely inappropriate and probably not inappropriate, but just really didn't get particularly at the psychological issues that Finametrica is so good at identifying and encapsulating in how you develop a risk profile. But this slide that you're looking at right now is a three-dimensional approach that we really hadn't been talking to clients about before we started using Finametrica. We certainly used the word risk tolerance, and we thought about how much risk people needed to take and could afford to take. But this really gave us the vocabulary to talk to clients not only about risk tolerance alone, but how does that interact with how much risk people can afford to take and how much they need to take, because very often you're sort of moving people in a direction because you've identified that perhaps they really do need to or could afford to take more risk. And so this risk profile, as it's identified here, is really, really helpful.
Okay, thanks, Beth. All right, and this is roughly, or this is in fact the sequence that I'm going to talk about, or the sequence I'm going to follow today. I'm going to start off by looking at what's involved in assessing risk required, risk capacity, and risk tolerance, and then how you go about identifying mismatches, because unfortunately the three of them very rarely line up, and then how you assist with the trade-off decisions that the client is going to have to make around those mismatches. And finally, how at the end of the process you confirm that the client actually does understand the risks in what you're recommending and what they've decided to do, so you can get your clients properly informed consent and commitment. Okay, let's start with risk required. You'd be familiar with this. I mean, it's just a question of essentially gathering the numbers, doing the number crunching. People go about it in different ways. Some people will do an IRR calculation and then use that to select an asset allocation. Others select a likely asset allocation and then use cash flow or stochastic modeling to do some iterative testing of goals. It doesn't matter which way you do it. It's just an exercise that needs to be done. It can be quite an illuminating exercise for clients, because it's the first time they've actually seen all the numbers being put together, and they'll get to see the key numbers, etc., etc. And what you're eventually trying to do is you're trying to position the risk return, the risk required, somewhere on the efficient frontier in general terms. And this is where you can first run into a problem, because you can find that a client's goals are way too optimistic given the financial resources they have available. Here you run into essentially the first set of trade-off decisions. If the risk required, if the return required is ridiculously high, then they're going to have to do some trade-off decisions here. And essentially they're going to be either easing their goals, so reducing, delaying, foregoing, or increasing their resources. Earn more, spend less, convert personal use assets to investment assets. If somebody's in the accumulation phase, usually the single most effective thing they can do is delay their retirement, simply because they get both together. They ease their goals because they're funding for a shorter period of time, and they increase their resources because they're going to be saving longer. So that's risk required. Risk capacity is something that people have really only been talking about for the last few years. I think Michael Kitces and ourselves started talking about it first about 4 or 5 years ago, and it's not a concept that I think is yet fully understood. It sort of tends to get mixed up with other things, but it's the extent to which the plan that you make can survive some sort of negative event. I'm going to try and explain it in firstly using a simplified scenario, so you get the concept. Okay. We've got this is the sort of single goal scenario. We've got somebody who's got a particular goal in mind. We've got Susie saving for her daughter's education. She's using a particular asset allocation with a particular investment return that is expected to meet the anticipated expenses. But of course, there's a 50% chance that she won't get the expected return, and there's also a chance that the expenses may be greater. So in this simplified scenario, the risk capacity will depend upon Susie's ability to fund any shortfall from other resources. If she can fund it from other resources, that might be well and good. If she has no capacity to fund it from other resources, you've got a problem. If she can fund it from other resources, though, to some extent that's robbing Peter to pay Paul, because that money would have had some purpose, even if it wasn't specifically identified as such. And so when you move into the comprehensive scenario, the problem is that you've got all the goals in there and essentially all the money in there. So if you pull money from one pot and put it into another, while you might advance one goal, you're going to detract from another. Now, I want to talk about this a little bit more. I'm only going to use, though, a single goal in this scenario because it makes the illustration easier. So here we've got a couple who need a 55% stocks portfolio to achieve their goals. How much risk capacity will they have if they choose a 55% stocks portfolio? None. No, pretty straightforward. Risk capacity is the extent to which your plan can stand a negative event. Okay. The risk capacity is actually it's about financial resources. Sorry, it's not about financial resources. It's about financial resources in relation to goals. So it's about how optimistic the goals are in terms of the financial resources that are available. And yes, people with high wealth and high income, you would normally expect to have more risk capacity than people who are low income and low wealth, but it does depend upon goals. It's a characteristic of the plan, not the individual circumstances, and it's measured by the likelihood of achieving goals in the event of things not going the way you anticipated. Now, depending upon the planning software you use, you'll have a greater or lesser ability to play around with this. Money Guide Pro software is really good at doing it because they give you the option of fiddling with various parameters in the plan, and you see the changes in the probability of success. So if we look at the plan there, as things are currently, chance of success is 50%, and the confidence zone that's been set by the client as what they want for this retirement is, I think the figure in there is 80%. So it's a very useful tool. You need some sort of a tool like that. Okay, so what we've got with risk capacity, it's going to involve some form of stochastic testing or stress testing of some sort. You will need to look at probably, or you'll certainly need to look at multi-dimensional goals. So if you've got a retirement goal of an income stream of $100,000 per annum, and that's what somebody would like, you also need to ask them, okay, let's suppose things don't go particularly well. What's the minimum that you could get by on? It would be okay. It would not be great, but you wouldn't feel devastated by it. And then the questions that follow that. Okay, how certain do you want to be of achieving that minimum? Now, people will say 100%, and you effectively can't deliver 100%, but you can play around and see what the consequences are of setting a likelihood target on that minimum acceptable. And for their sort of desired one, they might be working at a 50% likelihood, might be what they're after, and there's playing around there. It's important to consider the likely range of investment returns, not just the expected return. You've got to take longevity into account, and you have to allow for increased expenses and reduced resources. So it can be quite a tricky exercise. Okay. Now let's get on to risk tolerance. And what we're really talking here is the soft stuff about clients. I mean, I've been talking number crunching up until now, and accountants will be good at that. It'll be second nature. It might be an area where the typical planner is not too strong, but I think it would be, without offending anyone, I think it would be fair to say that accountants would not generally be seen as having great interpersonal skills. So when it comes to the soft stuff about clients, that's not necessarily a strength. What do I mean by soft stuff? I mean, for example, how clients like to absorb information. Do they want it written? Do they want to talk to them? Do they want to do it face-to-face in meetings? How do they want to interact with you? Frequently, infrequently? Do they want a formal or informal relationship? How personal do they want the relationship to be, etc., etc. So it's soft stuff. And probably the most critical one is risk tolerance. That's the one you absolutely must get right. Because if you get it wrong, you and the client are likely to be in deep trouble. Okay, the first thing about risk tolerance is that people tend to think of it as an upper limit on a negative. And it's not that. It's a comfort zone. It's a comfort zone between too much risk and too little risk. In a financial situation, too much risk would mean you put your financial well-being at risk as far as you're concerned, and too little risk would mean you're not making the most of your opportunities. It won't be a point, it'll be a range, and there'll be some flexibility around the range. Risk tolerance is, I think, pretty clearly an aspect of personality. And when we started looking at this exercise, we actually went to psychology to find out what was known about risk tolerance. And we discovered that psychologists had been looking at risk tolerance for nigh on 60 years. They were very clear that it was a psychological trait that is relatively enduring way one individual differs from another, that is pretty much set by early adulthood, as a result of genetics and life experiences. There are 5, it's essentially an aspect of personality. There are 5 different domains. People behave consistently within domain, but not across domain. So a physical risk taker may or may not be a financial risk taker. And there are no subtypes within financial, so you don't get investment risk tolerance and borrowing risk tolerance and insurance risk tolerance. You simply have financial risk tolerance, and it plays out in any situation involving financial risk. The other thing we learned from psychology was, how do you go about assessing a psychological trait? Because it's obviously a big part of what psychologists do. And there are, essentially you can divide assessment techniques into 2, interview or test. Psychologists are very clear that testing is a more accurate way of doing things than an interview. The ideal way, and they established this back in the 1970s, to much consternation in psychology at the time, because psychologists thought they had great interpersonal skills and they were offended by the fact that some of their brethren were saying, hey, a test is better. The ideal way of doing things is to have a test as objective input to an interview. This is all really about the discussion, the risk discussion that you have with clients. And while we bang on about the integrity of our tool, etc., it's a tool, right? It's something that you use as part of the process. There's a discipline called Psychometrics, combination of psychology and statistics, which provides standards for developing tests and standards for measuring tests to see the quality of the test. It concentrates on validity and reliability. Now, I think the simplest way to think of these concepts is validity is on target and reliability is tightly grouped. So in my first target there, I've got a reliable but not valid test. It's tightly grouped, but it's off target. The second one, I've got a valid test. It's the result, it's scattered around the bullseye, but it's not reliable because it's scattered. The third one is a scattered result, off target, neither valid nor reliable. And what you're aiming to get to is valid and reliable, on target and tightly grouped. And that's really what a good psychometric test will do. There's quite a process for developing a psychometric test. I mean, back in the late 80s, after the October '87 crash in Australia, and that was pretty scary. Markets went down 40% in a day and continued to fall for about a month. One of my partners and I sat down and we developed a risk questionnaire, and you've all used these risk questionnaires. You know, it's got the 8 or 10 questions, and we thought up a scoring algorithm, etc., etc. Developing a psychometric test is a much more difficult exercise. You run usability trials to make sure that the questions you're using are understandable and answerable. They must be plain English. They must not require explanation. If they require explanation, A, it's going to take your time, but B, it's going to bias the results. And they need to have statistical qualities. Once you've got questions that have got usability, that is, your testing has shown they're understandable and answerable, you then run more trials where you do the statistics to make sure that the questions work statistically, and you find that some of the questions that have high usability have no statistical value. They don't differentiate from one individual to another. It took us about 18 months to develop our test. We used 25 questions. We actually tested 152 different questions to get there. A couple of years ago, with 2 US academics, I wrote a paper for the Journal of Financial Planning where we talked about all the technical stuff around this. And those of you, the engineers in the audience who want to go read something, you could find that in the journal, or it's on our site if you want to have a look. I wish we'd thought of doing what a PhD candidate at Golden Gate University thought of doing. He was doing his PhD on risk tolerance, and what he did was he went out and he collected as many of the sort of industry standard questionnaires as he could get, and amongst other things, what he did was he went through each of them, answering them as conservatively as he possibly could, and then he went through them all again, answering them as aggressively as he possibly could, and then he looked at the difference in the recommended asset allocation that came out. Whoops, have I cut this slide out? Surely not. Where's it gone? Sorry, jumped ahead of myself. I'll have to go back to the other one. Well, that one, if I just go back. This was the sort of industry standard one that he was using. What happens is there are bad questions in there. Bad questions are ones that are off the topic or too complicated and require explanation. And they tend to try and combine risk required, risk capacity, and risk tolerance, so that if you get somebody with high risk tolerance and a low risk required, what you get out is an average. And similarly, if it's the other way around, then clearly both of them can't be useful, can't be right. And it's not a particularly enjoyable experience for either party, and usually it's just done quickly and put to one side and you've ticked the box. But back to this experiment. When he tested on the least risky answers, he found that the recommended asset allocation ranged from 0% to 70%, and when he tested on the most risky answers, the recommended asset allocation ranged from 50% to 100%. So very clearly, if you were a client, what you finished up being recommended was not based on your situation, it was based on the questionnaire that you were used, which is a pretty nasty circumstance. Now, all this stuff is actually known through independent studies, and one day plaintiffs' lawyers are going to discover it, and that will be a very interesting situation. Part of the way it plays out, I mean, this is a difficult area. Getting a handle on a psychological trait like risk tolerance is not easy. Nobody's going to pretend it's easy. You can fairly quickly pick up in an interaction with a client how sociable they are, because you'll get that from the interaction. But it'll take you a while to pick up whether they're detail-minded or not, and it would certainly take you significantly longer to pick up how risk-tolerant they were, and you then might get it wrong. One of the things that I think is the result of the process, the difficulty firstly in doing this, and secondly in the tools that advisors have had available, is studies show that advisors' accurates of their clients are less accurate than the client's self-estimate. So you'd be better off actually saying, how risk tolerant do you think you are, and leave it at that. They exhibit gender bias. Male clients are thought to be more risk tolerant than they actually are, and female clients are thought to be less risk tolerant than they actually are. And it doesn't matter whether the advisor is a male or a female. So it's a gender bias, not a sexist bias. Other demographics get overweighted. People with high income and high wealth are thought to be more risk tolerant than they actually are. Low income, low wealth. The effect of having numbers of dependents, etc. Other demographics are not particularly strong. The only really strong ones are gender and age. Typically, advisors' estimates correlate with test scores at around 0.4. What does this mean? Well, 0.4 is, it's not too bad a correlation, but it means you make a major error in 1 in 6 cases, or put another way, advisors would be more accurate if they made no attempt to assess clients' risk tolerance and simply assumed that everybody was average. Okay. One of the things that comes up about risk tolerance is it goes up and down with the markets, doesn't it? Well, no, it doesn't. The blue line is our average monthly risk tolerance score. So you can see that so we take the average each month of the scores for the profiles we've done. So you can think of that as being a sample. We go back to the population every month and take a sample. And the red line is MSCI World. The blue line does trend down a little bit, but that's because the composition of our sample changed. We know that Australians are, we started in Australia, then went to the US. Australians are more risk tolerant than Americans by a little bit on average. We then went to the UK, and Americans are more risk tolerant than those in the UK. So as the composition of the profiles has changed, we would expect a minor decrease. Now that will be, a challenge for some of you. You'll be of the view that risk tolerance goes up and down with markets. There's a paper you can find on our website, talks about this in quite some detail. You are right that behaviour changes, but the assumption that risk tolerance is the sole driver of behaviour is where the weak link is. Risk tolerance, risk perception, a number of factors will drive behaviour. What changes as markets go up and down is that risk perception changes. Okay. Somebody might like to ask a question about that later on. We come to our questionnaire. To get an accurate measure of risk tolerance, you get a reasonably accurate one with about 12 questions, maybe even 10, 15. We have 25. Now, the reason that we have 25 is we're not just trying to get an accurate test. We're also trying to seed the conversation between advisor and client. We cover a whole range of aspects of financial risk. One of the ones that's particularly relevant to accountants is that we have a question in there essentially about attitudes to tax minimisation. Now, you would well know that some people, their worst nightmare is they're in trouble with the IRS. They'll feel they've cheated. If it becomes public, their friends will feel they've cheated, etc. On the other hand, there are others who the last thing they want to do is pay tax. They simply don't want to give the government any money at all if they can possibly avoid it. So it's a question that's in there, and it's really to give you the opportunity. And you often get an aberrant answer on that question. So they'll answer that question quite differently to how they answered all the other questions, and that sort of difference will be highlighted. The questions are really simple. Some of them are really quite general, like this. Others are specific to a particular aspect of their financial affairs. As you can see, plain English. And this, I mean, I'm hoping most people have actually gone and done the risk profile. There was a link provided. We can provide it again. I've got it again at the end of the presentation. And there's a 2-page report comes out. It's got a whole stack of information. It's a mix of quantitative and qualitative, and there are built into that report. There are essentially 18 different points that can trigger a conversation with a client. We compare how risk tolerant they are with how risk tolerant they thought they were. We look at how consistently they answered the questionnaire. Some people are very consistent, some people aren't very consistent. We look at where they differed from those of similar to risk tolerance to themselves, etc., etc. Okay, so that's very quickly sort of, I guess, an introduction to psychometric testing. Good psychometric testing will look like this. Now, we have the only psychometric risk tolerance testing available in the US. In other markets, say for example the UK, we now have 4 or 5 competitors there, nowhere near as good as us, of course, and you don't have to sort of talk about what a psychometric risk tolerance test is. But Beth, if I can hand over to you and ask you to talk about how do you introduce the test to clients? How do you position it? Do they do it online? Because this is an online test, you can do hard copy. What's the client's reaction to it? How do you discuss the report with them? And how do you handle differences, risk tolerance differences within couples? So if you could go for it, please.
I would be delighted to do that. You know, as I was listening to you and you went over some of those earlier slides, you know, there's sort of a mea culpa because we used to have a questionnaire, which we thought was pretty darn good, but, you know, had those questions, it's a little bit more than 8 to 10, and, you know, ask questions, which we look back now and realize that, you know, for a lot of clients, you know, they didn't really understand all the questions. In some cases, they, you know, they almost involve some math capabilities that I think were challenging for some clients. Probably some of them were bad. And what we discovered after 2008 and 2009 was we got comments from clients like, well, you know, I just answered it the way I thought I felt then, but, you know, I never realized that we could have a downturn like the one we had in 2008 and 2009. So, you know, now if I were to fill it out, it would be completely different. So the other one of your slides that was kind of interesting was the consistency of the risk tolerance scores regardless of how the market is performing, which is in fact what we have been seeing now that we're using the test, that clients really feel so confident of the fact that we have measured their risk tolerance in a way that is truly representative of how they think, feel, etc., that they are, you know, they don't react as much, or in some cases hardly ever react to market changes. So that's a little bit of background. We give clients the Psychometric only online. Nobody has ever asked us to have it in print, and we've actually never really offered it because we think people kind of enjoy the fact that they can go online. We always give access to each of the couple if we are working with a husband and wife, because we absolutely want to know the risk tolerance of each of them. And we give it, you know, sort of a little introduction before we ever give it to them, which is we emphasize that it's psychometric and that it's backed up by good research and that it encompasses not only sort of your traditional questions about risk, but some things that will surprise them, but that have been found to result in a description of their risk profile that's really quite accurate. And, you know, in our process, we typically, you know, give the client a personal financial planning questionnaire and ask for a bunch of documents, and at the same time we say, you know, we're going to send you a link to the Psychometric test, and so it's an onboarding part of our process. So it's a very early in the new relationship with clients. And frankly, we've also use it with existing clients. We didn't do that initially, but now we're finding that we really, really want to learn about the risk tolerance of some of our longtime clients, and in some cases, particularly with those clients that chose to get out of the market in March of 2009, those clients have to take it. So we're now several years down the road with those folks. Clients love it. I really have to say that it's interesting to them, it's unique, it's a different approach. People find it quite intriguing. And when we go over the results, what we do, and I don't, looking at the slide that Jeff left up on the screen, we created a sort of a summary for discussion purposes with our clients, which incorporates a number of the elements that you see on this report, but we did customize it. So the first thing we do is it's a two-page report. It's very easy and well laid out. That first of all starts with, this was your actual score, this is what you guessed your score would be, because that in and of itself is an interesting conversation point with clients. In some cases, someone says, oh gosh, I didn't really understand, there's no way I meant to guess that my score was a 5. That sometimes you get these really crazy numbers, but interestingly enough, sometimes people are very, very accurate. They're either right on the button or very close to it. And then we create this bell curve chart that you see here so that they can see where they are in terms of other people who have taken the test and where they are on the bell curve. We tell them, what their score is, that this is either, higher than average score or lower than average score, and that where it places, what risk group it places them in. So that's sort of the way we set the table, so to speak, for the conversation. And then we move to the next levels of what these risk groups mean. And for instance, each risk group has a risk return mix of low, medium, and high. So we show the client what those are. Also, there's a split between defensive and growth, so we show them what those would be for their various groups. And then it converts to an asset allocation or recommended, suggested allocation. It certainly isn't an absolute. And I think that is one of the most useful aspects of using Phonometrica. When I look back to the way the questionnaire we had before, it really didn't give us a clear path to creating something like risk groups, nor did it really give us a clear path to taking that information and creating an asset allocation for clients. So this has really been enormously helpful to us in building portfolios that are accurate, or about as close to accurate as you can get, taking into consideration what someone's risk profile is. Now, the part about how do you handle the couples discussion is, I know a little bit later on, Jeff's going to spend a little time talking about mismatches, and I'll spend a bit more time on that as well. But what I do want to say is that it's rare for clients to have the same score or to find themselves in the same risk group. And this is where, for those of you who are what people think of when they think of CPAs, very analytical, not so comfortable with the soft side, this is maybe where you want to bring in one of your associates who is more comfortable talking about things that can, if they're expressed not quite right, make people a little anxious or unhappy or uncomfortable, because in some ways it's a little bit like couples therapy. I've only had once a couple where the husband, in this case, did have a really high score. It was like 75, and the wife had a really low score, like in the 20s. But they actually had a very nice marriage and a very nice relationship, and she looked to him completely to make financial decisions. And so she said, no, I'll just do my own IRA and my number 20, and you can do everything else. But what happens more often is that you'll get somebody, say, who's a 3 and somebody else who is a 5. And what we find very helpful is there is a table, and I don't know if you're going to show this later, Jeff, but a table that shows the way a typical 3 or a typical 5 would respond to the questions in the questionnaire. And what usually happens when we bring that out to clients, we show them where they were not on the band of the typical way to respond. And what they realize is in most cases people have a couple of questions that are a little bit more conservative or a little bit more on the aggressive side than the standard way to question. And that's our lead-in to talking about how you're different, but you're not, totally different. And what usually happens at that point is if people have adequate assets where somebody really could manage their portfolios differently, if they do have different risk tolerances, then you really don't have to work too hard to try to find some sort of a middle ground. But in many cases, the assets are not so large that you can do that, or they're jointly held or something like that. And the goal is to discuss sort of the middle ground and get their buy-in. Is this going to be okay? Are you comfortable if you're a 3 and, he's a 5, or you're a 5 and, she's a 3, the other way around? What does a 4 portfolio look like? And are you comfortable with that? And so that's the kind of discussion that happens. And what's great about it is you learn an awful lot about your clients in that conversation. And that only helps to build the relationship that you want to have with them on not only investments, but throughout the financial planning relationship as well.
That's fantastic. Thanks, Beth. Okay, you mentioned mismatches there. Let's go on and look at that in a little bit more detail. We're talking about mismatches within couples. Let's look at what happens, and this is one of the tools we provide to deal with this situation. Mark and Nikki need a 55% stocks portfolio. Mark's risk tolerance suggests 40 and Nikki's 60. So what you get is you get something that looks like this. Now what we have here is the 2 spectrum bands are essentially their risk tolerance spectrum bands, and the green zone is the okay zone, and it's marginal on either side. And as you can see, there really isn't any overlap between their 2 green zones, their 2 okay zones. The current portfolio is a bit over a 40% stocks portfolio. Mark would be comfortable with that. Nikki would find it a little bit too conservative, but not too bad. The target portfolio, though, the 55% stocks portfolio, that's starting to get a bit too much for Mark. And so this identifies where there is this mismatch within a couple and between the couple and what they need to do to achieve their goals. And sometimes, it can be quite difficult. I mean, the case that Beth was talking about with somebody with a score in their 70s and somebody with a score in their 20s, there's not likely to be a middle ground that they're going to be comfortable with. So you're going to have to do, and they've got to sort of accept that, and whatever comes out as the result of their decisions, they're the ones who've got to make the decisions. So they might have to go back through the exercise and look at perhaps decreasing the level of risk in the target portfolio simply by reducing the risk required, by easing goals, or by applying more resources. And there are a number of different ways of going about doing this, and we provide some quite detailed guidance on that. But what you get is the classic mismatches and how you do the trade-offs. The critical thing is, I think, not it's fairly easy to say, particularly when markets are going well, oh, look, let's just take more risk. And the problem with that is if you go too far and markets crash, they'll bail at the bottom of the market, or the less risk tolerant one of the two will suddenly become the primary decision maker. I mean, I remember back to the days of October '87. We specialised in doctors, and doctors are pretty ego-driven, and most of them back in those days were male, and it was very difficult to get the wife involved in the discussion. And when they did, they normally deferred to the husband. But we had a couple of instances where clients came to us and said, look, I'm okay with I'm not comfortable with what's going on, but I'm prepared to stay the journey. But my wife has just panicked, and she's got visions of us being homeless, and she's a bag lady, and she hasn't slept for 3 nights. She's just completely panicked, and if I want to keep the marriage, I'm going to have to bail. Terribly sorry. So that's something to watch out for. The mismatches can be tricky. The key thing is to make sure the client makes the decision. They understand what the problems are, what the alternatives are, what the risks are with the alternatives, and then make the decision themselves. I think Beth's already talked about some of that in some of the comments she was making. I want to go on, and I'm sort of keeping an eye on the time. I want to make sure we leave some time for questions. To talk about how you explain, how you make sure that the client understands the risks in what they finish up doing. But this is also, they actually understand the risks on the way through the decision, because you'll be talking about alternatives, you'll be talking about different levels of risk in an investment strategy. How do you make sure they actually understand what it's all about? I think the industry as a whole does a really poor job on this. To give clients a feel for the experience they're likely to have with their portfolio, so that if we go into an '07-09 situation, they're not saying, this is completely outside my range of expectations. I never imagined something like this could happen. Because '07-09, people say, worst in living memory. Well, you'd need to be, well, certainly somebody my age, it's not the case. '73-74 was worse. Not too many people knew about that. So what we did was we wanted to find a way to illustrate what the journey was like. So we went back and we analysed historical portfolio performance starting from 1st of January 1972. We built model portfolios with asset allocations. We used indices as proxies for sector performance. We analysed the data on a monthly basis, and we produced a lot of information. We've recently done a major upgrade on this information. There's now 5 pages of information about each of 11 portfolios. We actually have gone to 11 portfolios ranging from 0% stocks through to 100% in steps of 10%. And we're getting very good feedback on this. We're not suggesting that everybody use all of it, but there's a lot of information there. It's very new, and we're getting feedback about which bits people like and which bits they don't think are very useful. And I just want to show you some of it now. This is available on their website. It's a free download. You can go and have a look at it. So what are the essential messages you're trying to get across to a client when you're talking about risk and return? And this is just my personal view. Right? I think the first message is uncertainty. Right? Mr. and Mrs. Client, I simply have no idea what your journey is going to be like. Right? I can tell you what the range is, but what will actually happen to you is largely a function of luck. The and this chart's just to illustrate that. If somebody invested on the 1st of January, the result, we look at it at 72, 82, 92, and 2002. If they were lucky enough to invest on the 1st of January 1982, and this is showing $1,000 invested for 10 years, and its real values after inflation, they would have finished up with something a bit over 3,000 at the end of the 10 years. If they were unlucky enough to, if they invested 82, if they were unlucky enough to have invested in 72, they would have had less than they started with at the end of 10 years. And so there's that uncertainty. The next thing is volatility. I don't think there's any point. We've got means and standard deviations on this chart for the engineers, but really this is just rolling 12-month returns across this 40-year period. And they're extremely variable. Most of the time they're okay, but there are some pretty significant periods of time where the rolling 12-month returns weren't very good. One of the things we've spent quite a bit of time on is getting across the idea of rises, falls, and recoveries. So what we did was we went back and we looked at each month in this 42-year period, and this is a 70% stocks portfolio, and we just counted the months, and how often was it rising, how often was it falling, how often was it recovering. Now, this is a fairly busy chart, I'm afraid. Up in the top left-hand corner, we have what happens if you look monthly. If you look monthly at the portfolio, it's rising 42% of the time, it's falling 33%, it's recovering 25%. If you look quarterly, you find that it's now rising 57%, and the falling is 27 rather than 37. If you look half yearly, it's now rising 68%, and if you look annually, it's rising 77%. But clients do need to know that if with this particular portfolio, if they go and look quarterly, 27% of the time, or roughly that sort of number, it's going to be falling in value, and they need to be prepared for that. And if they're not prepared for that, then they shouldn't be in this portfolio. The point about doing the 6 monthly and the annually, I mean, some people only look 6 monthly or annually, but it's more when markets wobble, clients tend to look more often at their portfolios. And it's a good time to be able to bring this chart back out and say, look, you'll remember we looked at this when we were talking about risk and return at our last review. The more often you look, the worse it's going to seem. Now, I'm not saying don't look, but you do need to understand that this is the impact of looking frequently. Okay. That's very interesting, but if we're talking about falls, yeah, I know how often it's likely to be fall. How far is it likely to fall, and how long is that fall likely to be? So we have this analysis of depth of falls, and this is again for this 40, what is it now, 40-year, 41-year, 42-year period. Over this period, there were 64 falls in total down the bottom right-hand corner. Of that 64, 40 up the top left-hand corner were of 1 month and less than 10%. So if you blinked, you missed them. But there were some fairly substantial falls there. There were 2 in the more than 20%, less than 33, and 1 in the more than 33%. When did they happen? Here are the top 10 falls. Now this is nominal, not real. People tend to think of falls in nominal terms. So now, if you're talking to a client about a portfolio, you have to say, if 0709 happens again and you've got $1 million portfolio, it's going to fall in value for 16 months. And at the end of those 16 months, it's going to be 630,000. And, if you sell then, that's what you'll have, 630,000. If you're willing to wait 24 months, it'll be back up to $1 million. But you need to be able to handle that journey. And as you can see, there are a few big ones, and most of them are small and probably not of concern. Okay. Beth, let's go back to that one. Beth, I'd like you to, if you could, to talk about how you have the risk and return conversation with clients, because I think this is really crucial to the exercise.
You know, it's a very different conversation post the 2007, 8, 9 period than it was prior to that. Even though, especially in the part of the country I live in, the high-tech boom definitely occurred here in the late 90s, and then we had the bust in early 2000, but it didn't apply to a lot of people. And then, of course, we had some recessions, you know, in the early 2000, well, immediately following 2000, and then we had another market fall in the 2011 post period. But you know, the one that really stuck with people was, you know, the recent one. And what is very helpful now is that people truly do have an understanding of how they feel under the worst possible circumstances. And so it's much easier to go over some of these charts with them and talk about the fact that, yes, the market goes down, but if you wait, you know, it goes up. Or it can take a lot longer to go up than you think, but would you be willing to remain in the market? And having had that experience, people give you much more honest answers. They take Phinemetrica, and they really are incredibly engaged with it, and they really believe that this is a way to uncover what their risk tolerance is. So I have to say that the conversations are much more meaningful. They're much more reality-based than they were before. And with, you know, having this scoring system in front of them, clients have a lot more confidence in where their portfolio is today than I would say, you know, 5, 6, 10, 15 years ago.
Okay, well, thank you very much. That's sort of the end of the scheduled bit we were planning on presenting. I should say, which I don't think I did, a little plug for Phinemetrica. We've been going 15 years. We're a specialist research-driven organisation. We've completed more than 600,000 client risk profiles. There has never been a case of a client who used one of our profiles making a successful claim against an advisor. There have actually only been 3 claims, and they were dismissed out of more than 600,000. 5,000 plus advisors have used our system. We operate in more than 20 countries around the world. And for accountants, I should mention that there is actually an AICPA discount of 10% currently. You can do your own profile at the risk profiling site. It's our information portal. It's your risk tolerance, but you can probably find it easy enough if you just go to the site. You can also trial the system for 30 days, and that's my email address if somebody wants to contact me. So I now might hand it back to Bob and for questions.
Thank you, Jeff, and thank you, Beth, for your presentation
Sarah.
today.
I'll hand it back to you.
That's okay. I took my cue as needed. We do have one question in the queue before we wrap up today. It's from Ted. He's asking, the MoneyGuide Pro software program without Phinemetrica has a slider showing the percentage of loss of the portfolio under the 2008 market data in comparison to others. How valid is that shortcut approach? Can either of you speak to that?
Yeah, I can. I mean, I know Bob Curtis really well. MoneyGuide Pro has been a great supporter of Phinemetrica. We've been integrated with MoneyGuide Pro since 2005. I think it's there as an option. I talked to Bob about they used to have a default questionnaire on there as part of MoneyGuide Pro, and he knew, you know, it was rubbish like the typical industry standard ones, and he wanted something different. And he came up with the slider idea. It's better than what they had, you know, and it focuses on, it's really a single question risk tolerance test, which is how much of your money could you afford to lose? Now, it's a very important question, but it's only one question. it doesn't give you, there's no richness to the experience for people, and I would be reluctant to rely on a single question, but it's neat. And certainly the people who use Finametrica also play around with the slider. Yeah, I don't want to damn it with faint praise. It's okay. It's not a complete solution. It's certainly better than what they had. It will trigger discussions.
Good. Thank you, Jeff. Well, we are out of time for today, so I will conclude today's presentation with another big thank you to Jeff and to Beth. And with that, I will wrap up with a couple of resources. One thing I'd like to draw our audience's attention to is the proposed statement on standards in personal financial planning services. There's an exposure draft available for public comment until September 9th. The objective of this proposed standard is to provide process-based guidance to AICPA members who provide personal financial planning services, and it applies to the delivery of PFP services, not services covered by other AICPA standards. You can find more information on the exposure draft on our website at the URL listed on your screen. A couple of other items to point out, as Jeff mentioned earlier, we do have a 10% discount on Finametrica for our PFP members, including PFS credential holders. We also have a couple of white papers available, Risk Profiling, Art and Science, and the Stability of Risk Tolerance. Those can be found on the PFP website as well. In addition, we have Four-Field Advisor, which is a client education and communication tool written by CPAs, attorneys, and other subject matter experts. If you do a keyword search on risk tolerance, you'll find some additional information that you can share with your clients. And Jeff will be back with us next week at this time and the week after for a couple of more sessions building on today's initial presentation. You can find our complete calendar and registration links on our website at aicpa.org/PFP under CPE and events. And this event and all of our events will be archived for our PFP section members and PFS credential holders at aicpa.org/PFP/webseminars. And finally, we have some PFS news and events going on. I'll let you read through those on your own for the sake of time. If you need more information on that, you can visit our website at the URL listed on your screen. And with that, thank you everyone for attending, and thank you again, Jeff and Beth.
My pleasure.
Thank you.